Hi, and welcome back. I wanted to talk to you guys a little bit about hard to borrow stocks. Now, the borrowing market is one of the sketchiest and shadiest parts of the stock market world. But before we get involved with that, it's hard with this channel to produce content sometimes that because I don't know which level to talk about things at, and I'm certainly not an expert in most things in life, but there are some things to do with the stock market that I know more than a lot of people about, and I'm sure there's people on my channel that know some of the stuff better than I do who are watching this, and I certainly do get corrected sometimes by people. So feel free to do that if you think I'm saying something that's incorrect. But other times I feel like I'm either providing too basic information or too advanced. So I try to sort of find a level. But I'm pretty sure that some of the stuff that I have to say about hard to borrow stocks, many people won't know about who are just general retail traders. So let's get started just with the difference between being long a stock and short a stock. Now, in the old days, when you bought shares of stock, you actually would get, I think, stock certificates, and that's kind of before my time. These days, obviously, when you buy a stock, it just goes into your brokerage account that you're long the stock, and if you want to short a stock, people have a hard time conceptualizing shorting a stock. It's difficult. It's a really difficult concept for people to think about selling something that they don't actually have. Now, I think it's a difficult concept for people with options too. Somebody to say, "Oh, well, I'll sell you some calls." It's like, well, you don't own any calls. How can you sell them to me? Well, with an option contract, you and I were making a deal between us. I'm saying that I will deliver you the stock with a call. If you want me to, I will deliver you the stock at whatever strike price I sell you the call for. And it's being there's a person in between us, or structures in between us that make sure that I make good on the deal that I set forth when I sell you a call. Everything in the end is guaranteed by the Options Clearing Corporation. But that's the options world. The stock world, it used to be the stock world was just based on two exchanges. It used to be listed stocks, or stocks that trade on the New York Stock Exchange, and NASDAQ stocks. Those used to be like the two main things. And NASDAQ stocks were traded in a number of different ways. When I first traded, a lot of the NASDAQ stocks were traded over the phone. We would stand in the pit, and there'd be somebody, a phone clerk, who would be standing in this row of phones off to the side. And if we could see them, we might signal to them or yell towards them, but more often we would call them from our pit. Somebody would pick up, and they would look at the level 2 screen, and they had relationships with different houses. And so they would call Merrill Lynch and say, "I need to sell 7,000 shares. Can you fill me?" And they would get stuff done. And there was a certain give and take with stock clerks and stuff. Sometimes a stock clerk would say, "Look, this guy's hung on 1,000 shares. Can you take it down?" And so instead of selling, 6,000 shares, I might sell 7,000 shares to accommodate an error or something like that. And that might be an error from our firm. It might be an error from or a customer thing for Merrill Lynch. But there was a little give and take in the business because everybody makes mistakes sometimes. Somebody's going to be hung on an order sometime, and we try to accommodate people back and forth. But I digress. There were two exchanges when I first started. There was New York Stock Exchange, or listed stocks, and there was the NASDAQ or OTC stocks. New York Stock Exchange, all the trades had to go through the New York Stock Exchange. So you had to get an order from you to the floor of the New York Stock Exchange. So the way that would work for me is, once again, I'd call my phone clerk. They would call the New York Stock Exchange. A runner would go out and hand the order. Then everything went electronic since then. And there's many, many different networks that trade stocks. And there's all kinds of computerized stuff going on, payment for order flow, and there's a ton of different topics which we could get into. But essentially, when you buy a stock, somebody who owns the shares is selling them to you. And once you own the stock, it's yours until you decide to sell it. Nobody's going to take it away from you. That is, unless you're using margin and somehow you can't cover the margin. But in general, if you're long a stock, it can't get taken away from you. Now, let's talk about short stocks. So when you short a stock, you need to borrow the shares to short from somewhere. And in most stocks, this isn't a big deal, because if you think about something like Merrill Lynch, they've got all these customers who have accounts and who are just, a lot of rich people just own a bunch of stocks. They own a portfolio of stocks. So if somebody wants to short IBM, Merrill Lynch can just go to one of their thousands of customers who are long IBM, borrow the shares from them, and then you can short it using those shares. There's so many people that are long IBM that none of them are going to need it back anytime soon. So you can, that stock would be considered easy to borrow. But there's some other stocks that a lot of people want to short. Either a lot of people want to short them, or there's just not that many shares out there, or not that many people have it in their portfolio, and it's harder to find stock to short. In general, it obviously makes sense that in general, you want it to be associated with a bigger house like Fidelity or Merrill Lynch or Goldman Sachs, a big, well-known firm, because the bigger the firm you're dealing with, the more likely it is that they're going to have shares to borrow of whatever it is that you need to short. So what happens when there aren't that many shares available? Well, they figure out ways of who gets whatever shares are available to short. There's this like shady business that goes on to decide who's going to get those shares that need to be shorted. And it works in a variety of ways. One way it works is that you have to pay a percentage to short the stock. So like they're gonna charge you interest on those shares that they're loaning to you. And the more people that want to borrow the shares, the higher that interest rate is, and it just moves around. Another thing that will happen a lot of times is that if you are a big customer, then you've got $200 million or $200 billion under assets under management with this company, they want to keep you happy, so they're going to give you the shares to short ahead of someone else. Another thing that's very common in the hard to borrow business is that you go and you call your guy at the company and you say, I'm going to need 5,000 shares today. Can you reserve 5,000 shares for me, or 10,000 shares, whatever? And they'll say, yeah, we'll hold on to 10,000 shares for you. So if you need to short it today, you will have access to up to 10,000 shares. And that's very common. Another way that you can get long stock is as an options trader. You can go in and to another options trader and you can say, I want to trade the reversal conversion. Now, what's the reversal conversion? The reversal conversion is to pick a strike, and as a package, you are going to buy stock, sell a call, and buy a put. So when you sell a call and buy a put on the same strike, it's the same thing as selling stock, right? Or it's very similar to selling stock because it operates the same way. You short a call, long a put, you end up short 100 deltas. So if you sell a share, and if you sell a call and buy a put and buy stock, then those two things cancel each other out, because selling the call and buying the put makes you short 100 deltas. Buying 100 shares makes you long 100 deltas. And thus, you are converting your options trades to your combo into stock. Now, what happens when things are hard to borrow is instead of the options prices adding up to the price of stock at that price, you're going to have to pay maybe a little extra. So instead of it being a zero-sum game, it's actually going to cost you to get that long stock, because for me, if I'm the trader in the pit, maybe I might have a position where I am short a bunch of calls. And for me, being short a bunch of calls, to hedge them, what I did was I bought stock. So maybe I'm short 500 at the money calls, and I hedge them at a 50 delta. So I'm long 25,000 shares of stock. And maybe I'm willing to give some of that stock up to people who, for hard to borrow, because they're willing to pay me $1 to borrow that stock for a couple weeks. So I do the combo, which expires in a couple weeks, and they pay $1 over for it. And I give up some of my long stock for that. Or I might not even have any long stock, but because it's so rich, the trade of trading that reversal conversion, usually a reversal conversion will be traded right around even, because unless there's a dividend involved, the only difference is interest. So, but you could go into a pit and say, I want to trade the reversal conversion. They make a market on it, and you trade it with them, and you get the long stock by converting a combo in the options to the stock. Another thing you could do is you could go into a stock and you could buy deep puts, like 90 delta puts, and then buy puts in stock, so that basically like you're synthetically getting long stock for a cheap price. Other thing you can do is instead of getting long stock, you could replace it with calls. But when you have a situation where something is hard to borrow, people much prefer the stock to the calls. So what this does is it essentially in the end makes calls less valuable, because if someone has a choice between the calls or the long stock, they definitely prefer the long stock. So it makes calls less valuable, makes puts more valuable, because when you buy puts, you can hedge them with stock, and then you've got the long stock. So if you notice in BYND, for example, it's almost as if the stock is centered a couple dollars lower in the options. It's like the options right now with stock 222, the stock is actually, it's almost as if you told the model that the stock is trading 220 instead of 222. And they center the stock at a lower price because they know that the reversal conversion is out of whack because people need long stock so much. And if this is confusing you a little bit, I'm sorry. But let's go on to hard to borrow and buy-in risk. Okay, so what is buy-in risk? Well, when you're short a stock, you had to borrow those shares from somebody, right? You might have borrowed them from your firm. Merrill Lynch might have borrowed the shares of IBM from some wealthy person who owns a zillion shares of IBM. Now, sometimes the person who loaned those shares to you needs them back for some reason. Maybe a whole bunch of people sold out of their IBM positions, and for whatever reason, they can no longer hold on to those. They can no longer let you use the shares that you used to short the stock. So what happens then is that you get bought in. And this is a risk, because if you're short the stock, a lot of times you're hedged against something. So let's say I bought 100 calls and I sold stock against them. So now I'm flat delta, because the delta of the long delta of the calls is offset by the short delta of selling the stock. if I get bought in, all of a sudden I'm a lot longer than I thought I was, because that stock that I was short all of a sudden disappears and my delta changes and I'm a lot longer than I thought I was. And a lot of times when you get bought in, you don't find out right away. The buy-in takes place as of the opening of business, whatever day it is, but you may not find out you got bought in until like 10 in the morning. And so you can, all of a sudden your position can be messed up and you can find yourself a lot longer than you thought you were, and you've been a lot longer than you thought you were all day. And what most people do when they find out they got bought in is they immediately sell out some new shares. And just because of the way the process works, the firm will go and find shares to borrow from a different spot to replace the shares that got called away. And as soon as you sell the shares back out again, your position is back intact. But this can be a really scary situation because you don't know when you're going to get bought in, and it's a serious risk, because what happens if you get bought in and that day you get bought in, the stock is way down, and all of a sudden you find out that you've been riding a long position that you thought was flat down $5 or something. Well, you're going to lose a lot of money. And so the buy-in risk is a scary thing. Going back to it for a second to who gets the stock, who gets to borrow stock to short it. I know that, for example, TD Ameritrade, they have a hard to borrow program, but you have to be a portfolio margin customer. A portfolio margin customer is somebody who has, I think at least 150. It's either $125,000 or $150,000 in their account, and then you can apply to enter the hard to borrow program. Other brokerages have different deals, but it's kind of a sneaky, shady business, and it's one of these things where like you almost have to have a connection at the firm to really get in on long stock. Like the more people you know at the firm, and the closer you are to like sort of the center of power there, the more likely it is that you're going to get long stock. It's a weird thing. With TD Ameritrade, you don't know if something is too hard to borrow or not until you actually try to execute a short trade. It might say hard to borrow, and you might be able to execute shorting something, and it might work or it might not work. But like I said, at many other firms, it depends on which firm you're in and which situation you're in. But at many other firms, you can say, look, I'm going to need 10,000 shares today. And people can say, okay, we've put aside 10,000 shares for you today to short. But that still doesn't guarantee that you won't get bought in. And a lot of times with UVXY, if we talk about UVXY, the VIX ETP for a second, a lot of times with UVXY, it is hard to borrow. And people try to do something, they try to short stock in kind of a roundabout way. And so what they'll do is they will sell calls, and they will want to get assigned on short calls, because when you get assigned on short calls, you have to deliver the stock. And so you automatically, by the rules, are by rule short the stock, whether they can find stock to borrow or not. Your firm has to deliver stock to you to short if you are assigned on calls. So a lot of times people will say, okay, well, I know how I'll get short stock. I'll sell some calls, and I'll make sure that they're in the money on expiration, and then I will be assigned the stock, and that will leave me short after expiration. The problem with that, most times with at least TD Ameritrade, is they don't have the stock to short. So as soon as they're forced to deliver the stock because that's part of the options clearing. But as soon as that happens, the next day you're bought in right away. So if you're thinking that you'll try a sneaky way to get short UVXY by just selling some in-the-money calls and letting them get it assigned, it doesn't work. So people have thought of that before, but that doesn't work. So this, like I said, some of this stuff is confusing, and maybe you're hearing about it for the first time, but the good news is next time you hear about it, it won't be for the first time. And if you haven't understood everything I've talked about, once you've gone over it a couple times, it'll become clear. And I will explain this stuff over again. for you. So if you didn't understand all of it, that's fine. Hopefully you picked up a little something about hard to borrow. And, it's coming up again because of BYND. BYND is very hard to borrow. It has a very small float. A lot of people want to trade it. There's not that many shares available. It doesn't have huge short interest right now. I was looking, it's like something like between 5 and 10% short interest, but there is just no stock to borrow because there just isn't much of a float, and a lot of people want to trade it. And then the one other thing I wanted to say about buy-in risk is a lot of times a stock is hard to borrow, and it's possible that you will get bought in when the stock is being squeezed. Now, what is a squeeze? A squeeze is when a lot of people are short a stock, it starts to go up, and people who shorted it, they panic because they're forced to reach higher and higher to try to get those shares back. And when you have a lot of people short a stock and it starts to go up, it can become this kind of snowballing, self-fulfilling prophecy. And this happened to me once when I was, it was a hard to borrow issue. I was short like 9,000 shares. I got bought in on all my stock. I didn't find out till later in the day. And by the time I found out I'd been bought in, it was up like $5. So you can do the math. 9,000 shares, long 9,000 shares all of a sudden. I thought I was flat, but it turned out I was long 9,000 shares because I got bought in, up $5. So I made, a little under $5,000 on the buy-in. So instead of being a huge problem, it was awful. In my case, it worked out because the stock ripped up on a squeeze. So sometimes that can happen with you with hard to borrows, that actually, your deltas get messed up. You're forced to be long because you get bought in and it goes your way. But you'd rather have control of the situation than just randomly make money like that, because you could just as easily randomly lose money. So it can be a scary situation. Anyways, I hope this helps a little bit with hard to borrow, and we'll talk more about this in the future, but I just thought I should come on and talk a little bit about it because I know some people really get confused about hard to borrow and buy-in risk and this sort of thing. I will go over how you go in and trade a reversal conversion in the options in more detail in another video coming up, because I know that I wasn't super clear on that part of this description here. Anyways, I really appreciate you watching. I know it's a very specific thing that I do, and it's a hard format for me to expect to get tons and tons of subscribers, because there just aren't that many people out there that are doing like sophisticated options plays and stuff like that. When you think that the average person on YouTube is like a 12-year-old kid, it's harder for me to gain traction than somebody who's doing like Minecraft or something, I guess. But I love what I'm doing, and I'm enthusiastic about it, and hopefully that shows through in the videos. And if you follow me closely, you can watch the thrill of victory and the agony of defeat in trading, which is what I go through on a daily basis. And certainly today, BYND, I was getting close to, I was getting nervous on the close, and so I bought in some of my upside, which made me long some deltas. And I usually like to go out flat, but I ended up going out long deltas today just sort of randomly. And it was up, what was it up? $14 after the close. So things turned out good for me today, but it was total luck. But I'll take it. I'll take it. Any way that I can make money, I'm happy to take. So we'll see where it opens tomorrow. I am nervous. I did roll my short strike. I was short the 270 strike. I rolled that up to the 300 strike, which is a good thing, seeing as we're getting closer and closer. And I took off some of my risk. So now I'm short 2 calls to the upside and 4 puts to the downside. The puts I'm short are the 135 strike to the downside. And as it moves higher and higher, it requires more and more capital to be short those 2 calls. And there is a possibility that, although I might not buy those calls in, I might buy some more, try to leg into some more August to protect the upside. I continue to lean long because my risk is to the upside, and it continues to go higher. But, this thing is not going to go one way forever. There's going to be a day of reckoning here. And we have to plan for that, think about it, and try to position ourselves in an intelligent way for that day of reckoning coming ahead in BYND. Thanks for watching. We will see you again soon. And whoever that person was that gave me the super chat donation today on the other video, thank you so much. It didn't really come through. It said like comment erased or something. So if it was you that gave the super chat, thank you so much. Leave a comment, and so I can thank you personally for that. I really appreciate donation of any kind towards the channel. It just keeps me going, and it puts a big smile on my face. So thank you very much, and I will see you tomorrow, and we'll see where BYND opens. It's up 14 after the close. Just really trucking higher here. All right, thanks again, and talk to you soon. Bye.